Candlestick analysis. It's really a fundamental tool for traders who want to capture the essence of market sentiment and make your trading decisions. Now, candlestick charts, right? They're just not random patterns. They are the footprints of that battle between buyers and sellers. And each candle is going to tell you a different story about that battle. And understanding what that battle is and the information can give you an edge. So the basics, the body of a candlestick, that's just the spread between the opening and the closing price, the real body. When you see a wide body, that indicates a strong sentiment, either bullish or bearish. It just depends on whether the candle is closing higher or lower than it opens. The wicks, or the shadows, just shows us the highs and lows of the price during that particular period. And they represent price rejection. So a long upper wick shows that buyers pushed that price up, but they could not maintain it. That gives you selling pressure. Now, this is information that you get to use to add to your case for a particular trade. Now, you see these candles with bodies that take up at least half of the entire candle's range. Well, these are trend candles. And what they suggest is a strong move in the direction of the candle. And a series of these kind of candles just confirms that momentum. Now, when we see long wick candles, that's a big story. So in an uptrend, a candle that has a long lower wick, well, that indicates despite the selling pressure that came in, the buyers regain control by the close. And that often signals a continuation of the trend. You know, sellers that pushed hard at that open, but then they got taken out by buyers, and then it closed higher than the open. That's information that you can use. Next, we have momentum candles. These are larger than the preceding candles, and it shows a clear move in one direction. This is a sign of increasing momentum. And these candles, these can often precede significant price moves. So you got to understand these candles in context. That's really important. So a long upper wick in a downtrend near a known resistance level, well, that might just suggest a continuation of the downtrend because sellers pushed back against any upward price attempt. Of course, the flip side of that is a falling instrument, for example, all of a sudden sees a long lower shadow and then prices closing up on the day. That could be an impending reversal. So each candlestick pattern, from single bars to the complex formations out there, should be analyzed not in isolation, but as part of the larger market structure. So an example would be a trending structure of higher highs and higher lows. And then you see a strong up move. And then you see a gentle pullback or a sideways consolidation. Well, we're thinking bull flags that will resolve to the upside because that's the context of the market that we're in. But you also have to be on alert for big moves after that trend has already started. These large candles after a sustained run, these can turn into a strong reversal. A blow off top would lead to either a trend change or at least a stronger correction. So this approach is going to help you decipher that ongoing narrative, the story of market sentiment, and make your choices with higher accuracy. With candlestick analysis, it's not about memorizing a pattern. It's about understanding what you're looking at in terms of underlying buy-sell pressure. The market's language, right? That's the word for it. When you pay attention to the details of each candle, you get some insight into the underlying market dynamics. And this is going to allow you to anticipate future moves with greater confidence.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.